All right, the next question that we're going to focus on is PQ3-7. I highly suggest to my students for this specific question, I want you to attempt it on your own, applying the knowledge that I've taught you guys in the prior chapters and in the earlier videos for this chapter. So attempt the transaction and then resume the video to see how I do it. That way, if you're doing it incorrectly, my analysis and my description could change up your train of thought and put you towards the right track. So let's get started. Let's dive right into it. Once again, always read the description is very important because you're putting yourself into the shoes of the business and you could tackle the transaction properly. So Kelly Clark has been working at Staples as head cashier. She has for years heard her mother complain about the cleaning service she uses. Kelly knows she can do a better job, so she has decided to start her own cleaning business. So she has her own cleaning business. This business does not require a lot of startup money because she will be using cleaning equipment in the houses she cleans. All she needs are cleaning supplies and a uniform. Kelly will use her own car to travel to and from her clients' homes. The following business activities took place during February of 2015. So transaction number one, Kelly starts the business on February 1st, 2015, by contributing $1,000 cash. So let's break this down into two separate transactions. Then her parents loan her an additional $1,000 to help her start the business. The loan will have to be paid back in 6 months. So the first part of the transaction is Kelly invests money into the business. So remember, whenever the owner invests money into the business, that always gives rise to owner's capital. And she also invests in cash. So I'm going to add in another line here. So cash is going to go up by $1,000, and so is owner's capital. That's the first part of the transaction. The second part of the transaction is her parents also loan her an additional $1,000. Once again, students always get tripped up. Additional $1,000. That's just simply cash. Simple as that. Don't overthink it, right? And this is a loan, meaning this is going to give rise to a loan payable. So in this specific question, we actually have a loan payable account. So we're going to increase this by $1,000. And in this case, we're going to increase this by $1,000. Now, transaction number two, Kelly uses a credit card to register her business name. Remember, a credit card gives rise to an accounts payable because we didn't pay cash today. So accounts payable is a liability because now we have the future obligation. So our business name is Kelly Cleaning Services with service and material $60. So we know what the first part of the transaction is. We're going to increase the accounts payable by $60. And remember, a business name is considered to be an asset because it provides us with a future benefit. So in this situation, we're going to increase business license by $60 as well. Next, Kelly has a personal bank account, but she decides to open a bank account for the business at the local branch of the Bank of Montreal. So she chooses a Pacific plan for $6 a month, which allows her 7 transactions per month to be charged at the end of every month. So this over here is a tricky situation. So simply put, we opened up the bank account, but we haven't used that service yet because we're going to use it throughout the duration of the month. Also, it's $6 per month, but this is charged at the end of every month. So if you look at our accounting equation or our 5 elements, assets, liabilities, equity, revenue, expense, nothing happens. We haven't paid cash, correct? So there's no future benefit. There's no future obligation, right? We didn't invest money into the business. We didn't earn any revenues. And since we haven't consumed or used up this service yet, there's no expense. So for number 3, no entry. And this is going to go all the way across the board. Now, transaction number 4. Kelly purchases 2 pants and 4 shirts. She has the shirts embossed with her name. Total charges from the company is $189 plus HST. In addition, she purchased comfortable running shoes, which she will only wear inside for $98 plus HST from Payless Shoes. She pays for all of her purchase with a credit card. So in this situation, we could do one big combined journal entry or entry transaction. Because simply put, the 2 pants and 4 shirts plus the shoes is going to be her uniform. So this is going to give her a future benefit because she's going to be wearing these throughout her duties as in cleaning service. Correct? So simply put, let's do a few calculations. So once again, it's 189 plus HST, not including HST. So over here, let's do 189 times 1 plus 0.13. So that's the total cost for the 2 pants and the 4 shirts. Now for the shoes is $98 plus HST. So we're going to do 98 times 1 plus 0.13. And this gives us $110. Now we're going to add these two together to arrive at the total cost, which is $324.31. So her uniform supplies goes up by this amount. And remember, in the transaction, she paid using a credit card. We know credit card is accounts payable. So that's also going to increase by the same amount. Now, number 5 is using a credit card. Once again, a credit card is very important. Credit card is accounts payable. So now we've connected the dots. Whenever we have a credit card, it's always going to be accounts payable. So just keep that in mind. A credit card means a future obligation, which is a liability. Using a credit card, Kelly purchases a selection of cleaning supplies from TSS Supplies Limited in Mississauga for $489 plus HST. So we have to do another calculation. So cleaning supplies is going to go up by $489 plus HST, and accounts payable is also going to go up by $489 plus HST. So 489 times 1 plus 0.13. So transaction number 5, cleaning supplies, is going to increase by this much. And by the same token, accounts payable is also going to increase by that same amount. Now, transaction number 6, using a free website service. Kelly produces a website where clients can get an immediate quote based on the number of bedrooms and bathrooms. In addition, clients can book an appointment too. The website shows Kelly's availability for the upcoming 6 weeks. Kelly knows that convenience is important to the clients. She wants to attract young professionals. Nothing happens in this transaction in terms of the county equation. So we're going to ignore this as this is no entry. Transaction number 7. Kelly reviews house prices in Oakville using www.retailer.ca for areas with house prices greater than $600,000. As a result, she develops a flyer and goes to the UPS store to print out 600 copies for 7 cents each plus HST. She pays with a credit card. Once again, credit card means a future obligation. That's going to be accounts payable. But now we have to do a calculation. We have 600 copies at 7 cents each plus HST. And remember, since we didn't hand out these flyers yet, that doesn't constitute as an expense. These flyers are going to give us a future benefit because it could bring in future business. And remember, a future benefit is a definition of an asset. So let's quickly do the calculation. So over here, actually I'll do it over here. So it is 0.07 cents per times 600 flyers. So the total amount that we're paying for the flyers before tax is $42. Including tax, we're going to do $42 times 1 plus 0.13 to get 47.46. So transaction number 7, under prepaid advertising. Prepaid means that we're paying for it in advance, but we're going to use up the service later on. Once we hand out the flyers at a later date, we're going to use up those flyers. Once we use it up, that constitutes as an expense, but today, no expense. So 47.46 is going to increase by. And then, since we used a credit card, accounts payable is going to increase by that same amount. Now, in transaction number 8, we actually go out and deliver all of the flyers to the home. So now this constitutes as an expense because we consumed or used up that expense. And we distributed all of them. So simply put, now our prepaid advertising is going to go down now. It's going to decrease. That's why it's negative. And since we used up something, we consumed something, our advertising expense is going to increase. Remember, advertising expense increases, whereas our prepaid advertising or our asset decreases it because we're getting rid of that. We're getting rid of those flyers. All right, transaction number 9. Kelly will charge $25 per hour for her services with a minimum time of 2 hours. She will leave our receipt on the kitchen counter at the end of every service call. Once again, she hasn't performed the service yet, so no revenue. She hasn't been paid yet, so no cash. So in this transaction, nothing happened. So this over here is no entry once again. All right, let's go over to transaction number 10. Kelly will use her own car and she can deduct the business portion of all of her car expenses: gas, oil, insurance, license and registration, maintenance and repairs. To help her track her business usage, Kelly purchases Mile IQ, an iPhone app which tracks mileage, for $59.99 plus HST using a credit card. So she essentially purchased a software to help her run her business. And this software is going to provide us with a future benefit. So that constitutes as an asset, correct? So 59.99 plus HST. Once again, let's do a quick calculation. Times 1 plus 0.13. So our software, which is an asset, is going to go up by this amount. And remember, since she used her credit card, that's going to be accounts payable. Our liability or future obligation is increasing. That's why we're adding it. Transaction number 11. By the end of February, Kelly has provided the following services in exchange for cash. So in week 1, she did 2 homes for a total of 8 hours. In week 2, she did 7 homes for a total of 21 hours. In week 3, she did 8 homes for a total of 32 hours. And in week 4, she did 11 homes in a total of 33 hours. As you can see, the number of homes that she's done, the number of hours are increasing, which is obviously a good sign. Her business is doing very well. And she also mentions that she will charge $25 per hour for her services, right? So we have to do a calculation now. All right, let's do this calculation in Excel. So once again, week, number of homes, number of hours in total for the week. This over here is kind of irrelevant. It's just kind of there to trick you, just because if you analyze this specific question, it says that Kelly will charge $25 per hour, and there is no rate per home. This is per hour. So keeping that in mind, she worked 8 hours in week 1. So we're going to do 8 times $25 per hour to arrive at $200. So in week 2, she worked a total of 21 hours times $25, which is $525. In week 3, she worked 32 hours at $25 per hour, 32 times 25. Then in week 4, she worked 33 hours. So 33 times $25 per hour. Then to calculate the total, we're going to sum these guys together. We're going to do 200 plus 525 plus 800 plus 825 to arrive at 2350. So this is a total income that she earned, or her total revenue that she earned in the context of service. And it specifically says that cash was paid for this. Remember, cash is an asset, so our cash is going to increase. Now, the next transaction, Kelly determines that by the end of May, she has used up about 15% of her cleaning supplies. Online, she sees that BMO has charged her the monthly service fee. So we're going to break this down to 2 separate transactions. Let's first focus on the first one. Kelly determines that by the end of the month, she has used up 50% of her cleaning supplies. So if we go back to our transaction over here, cleaning supplies is 552.57. So we use up 15% of these. So 15% is what's going to constitute as an expense. Because remember, an expense is something that we consume or use up, correct? So to calculate that, I'm going to take that amount. So 552.57, and I'm going to multiply that by 15%. Because that's what we used up, correct? So that means now that $82 of worth of cleaning supplies is going to be reduced. So that's going to be a negative because we use that up now. Remember, once we use something up, that gives rise to an expense. So our expense is going to increase by that same amount. So this is negative, that's positive. Now they're saying that BMO has charged her monthly service fee. So we know that her monthly fee is $6 right over here. Right? So they actually took it out. And when the bank takes out money from your bank account, it's obviously going to be cash. So cash is going to be reduced by $6. And by the same token, our bank expense is going to increase by $6. Transaction number 13 now. So the software that we got, Mile IQ, tells Kelly that she has traveled a total of 1,428 km during the month, with 1,113 for business purposes. Her total car expenses for the month, both business and personal, were $192, which were paid in cash. So now we have to do another calculation. So out of the 1428, 1113 was for business purposes. So this is how we can set this up. We could have business, personal. So sorry, let's write business and total. So business purposes was 1113 out of the total of 1428. So to calculate the total percentage of the total that's going towards business, we're going to do a simple calculation. We're going to take this number and divide it by this number. So out of the total, 77.94% or 0.7794 is going towards business. So out of the total that was paid, $192, this percentage is going towards the business. So we're going to do $192 times this percentage to arrive at $149.65. Once again, since this is a 7, we're going to round it up to 0.65. So that being said, cash is going to be reduced by that amount. And by the same token now, our car expense, because we've actually incurred that cost, is going to increase by that same amount. All right, let's go over to the next transaction, number 14. Kelly now uses her cell phone 40% of the business, for the business. Her phone bill cost us $100 per month plus HST, which was paid in cash. So first, we're going to figure out the after-tax cost. Then we're going to times it by 40% to arrive at the cost of the telephone bill due to her business. So once again, we're going to do 100 times 1 plus 0.13. So I have $113. Add this amount, 40% was for business. So 45.20. So our cash is going to be reduced by this amount because we're paying it in cash. And now since we have an expense, we consume something, we use something up, telephone expense is going to increase by this exact same amount. Negative number, positive number. Now transaction number 15. Kelly pays for all business expenses charged to her credit card from her business bank account. So essentially, her entire credit card bill, which we said was accounts payable, is going to be paid in full now. So we're going to simply add up all of these guys. So it's the 60 plus the 324.31, the 552.57, the 47.46, the 67.79 to arrive at a total credit card bill. Let's do a quick calculation. Remember, this is accounts payable. So her total credit card bill is $1,052.13, and she's going to pay this in cash. Because how else are you going to pay off your credit card bill? It's going to be in cash. So we're going to subtract this from cash. And now since our future obligation is being reduced since we paid it off, we're also going to reduce accounts payable by that same amount. That's why that's negative. Okay, to finish this off, transaction number 16. At the end of the period, Kelly estimates that she will have to pay income tax of 25% on the income she makes in the business. Once again, we have to calculate income before tax first and then multiply that amount by 25%. That is the amount of the payable and the expense. So we have to record income tax expense and the payable because there's no way around it. We have to pay taxes on the profits that we make. Simple as that. That's a requirement within Canada by the CRA. And it's a payable because we have the future obligation to pay this amount off in the future, which is a liability. So let's do a quick calculation on this. Remember, we said that revenues minus expenses gives us profit before tax. So let's quickly do it over here. So revenues less expenses gives us profit before tax. So we know that our total revenues is just going to be the 2350. And all of these added together is going to give our total expenses. We don't include income tax expense because that's what we're trying to calculate in this specific question, correct? So we're going to add all these guys together, 47.46 plus the 82.89 plus the 149.65 plus the 6 plus the 45.20. Then we're going to subtract these two to get the profit before tax. To calculate income tax expense now, remember the formula is profit before tax times the tax rate. We know the tax rate is 25% or 0.25. So income tax expense is simply going to be this number over here times by 0.25. So 504.7. So in this case, we are now going to increase our expense by this amount. This is the cost of doing business. And since we're going to pay it off at a later date, we're going to increase our income tax payable by that same amount. So I highly suggest that you do this question again. Once again, do it in a way where you attempt each transaction and then resume my video to see if you're doing it correctly. Any mistakes that you're making, my video should be able to correct you right away, and that way you can change up your train of thought. And remember, think about it logically. Please do not memorize this. I'm telling you guys right now, if you guys memorize this, it's going to work against you guys because these transactions could change completely on the test. Meaning everything that you memorize for this specific question is going to go out the window. They're going to test you on how well you understand the material and not how well you guys memorize the material.